Kathy, let's begin with you. Have we seen off the worst of it?
It looks like maybe the worst is over. It doesn't look like it gets a whole lot better from here. So we're cheering the fact that it's not decelerating or continuing to decline at a fairly rapid rate. And maybe we've seen the worst of it. Particularly if we get a trade deal. We've got some lagged effect from the easing from both China and other central banks. So, you know, maybe the worst is over, but certainly the going forward is not going to be strong.
Jim Keenan, your thoughts?
Yeah, I think you got to bifurcate. I think the data is going to be mixed. I mean, I think there are components of the market or different regions that probably will continue to see weaker data or weaker news into the balance of the year. But I think there's a variety of data that will start to stabilize, and you're seeing that in already in corporate earnings. You're seeing that in some parts of whether it's PMI data or other things, that you start to see a little bit of stabilization. And I agree with Kathy. I don't think this is about upside levels of growth. I think this is about reducing the probability of a recessionary risk.
A thing that we've ventured through pretty much through the whole week so far is sometimes the information content of how a market responds to data is more valuable than the data in and of itself. And a simple way of saying that this week is that the Treasury market rallies on bad news have been smaller than the Treasury market sell-off on good news. What kind of signal is in that, Colin?
Well, the signal there, and it's a little bit troubling to me because I don't really support it, is just that to your point that really we have seen the bottom. We have seen the worst of it. And I just think it's pretty darn early to think about that, okay, now it's going to be there's a light at the end of the tunnel and we're going to move forward. I think the Fed's still too tight. I think what they say next week is important. The market has set them up to easily say we're going to pause until after the first quarter of next year, but I'm not sure what they're going to say exactly. So I think we need to see that play out, and we'll have a better feeling of what things are going to look like after next week.
Kathy?
I would say that the market has incorporated so much bad news that it really couldn't continue to react to bad news any further. We do think the Fed will try to pause after this next rate cut. We expect the rate cut next week. We think they'll try to go on pause because the issue is the cost of capital is not the problem that's hanging over the world right now. It's not the problem in Europe, certainly. It's not the problem in the rest of the world. It's not the problem in the U.S. So further rate cuts may not do that much, and so I think they want to pause.
Hasn't been the problem through much of this year, Kathy, and yet they still cut twice and are set to cut again. Why does it change? Well,
I think they uninverted the yield curve, which was important. They got the Fed funds rate pretty close to the neutral rate or below the neutral rate, which takes them out of being restrictive in policy. And now they can say, well, we're neutral or even a little bit accommodative.
Jim, your thoughts?
Yeah, you came into this year with some cyclical downside risk associated to, just coming off of the 2016 rebound, right? And then you had, the tightening of the Fed in the fourth quarter. So I would say that, the central banks, including the Fed, have been easing throughout the year, right? And you're starting to see, if you just look at financial conditions indices relative to economic activity, you've seen a pretty big divergence. So I would say, maybe not necessarily the Fed, but I would say collectively all the central banks have been easing. And I think that ultimately should lead to a level of stability. There are certainly things for downside risk associated to that, but I think the Fed will be very reactive to that, or even proactive associated to worry about what that looks for next year. And whether they stop or they keep going, I think is less important to me, because the trend is that they're going to be very accommodative. And I think from a stabilization of data, that's a pretty positive environment for not only credit, but I think you could ultimately see the equities melt up here in the end of the year.
We'll talk about credit and we'll talk about equities a little bit later in the program. Equities near all-time highs to end the week. Your thoughts, Colin, on the 10-year? You came on this program a long time ago when we were at 3 percentage points, maybe 12 months ago, saying 150 on the 10-year. We've reached that level. We're back to around about 180. You don't think the lows are in for this year, or do you?
I think the lows could possibly be in for this year, but I really like 10-year Treasuries at 180.
You're a buyer at 180.
I'm a buyer at 180. In fact, if I gave you a range for the next 6 months, this would be the high. So it may be that we get new lows in the first quarter of next year, but just to give you rough numbers, 1.25 to 1 3/4, that would be my 10-year range, and that's for the next half year.
What is it about the economic conditions that makes you bullish on a 10-year at 180?
Sure. Well, number one, negative interest rates in a lot of places, seeing new lows in many countries with respect to where their 10-year rates are. We haven't hit that yet. But also, as I mentioned before, I think the Fed's too tight. We're basically where we were in June of last year right now. So if they ease one more, that to me that would be the first ease, because as you know, me being on the show last year, I was dead set against the last two tightenings, and I think there were mistakes, and so I'm hoping that the Fed has figured that out, but I'm not sure.
Kathy, a buyer at 180?
We think fair value is right around 180 to 190 in the 10-year. Now, that being said, if the global PMIs actually turn up and just stop going down, that would raise our fair value because that's a component of our estimate. But our range is closer to 1.5% to 2% for the next 6 months or so.
Jim Keenan?
Yeah, I would say long term it's okay, but in the short term, I think there's more risk that it leaks wider just on our stabilization of data.
Looking at the data so far through this week, PMI's not great. The EFO, there was this small ray of hope in German business expectations. But beyond that, Kathy, do you see any signs of stabilization?
Well, again, it's not deteriorating at a rapid rate. The slowdown has slowed down, so to speak. So that's somewhat stabilizing, but I don't see a lot of positive upside. I don't see a reversal in the rate of economic growth coming.
To revisit the start of this conversation, though, Kathy, the data in Europe hasn't been fantastic. Bund yields this week, though, nothing. Done absolutely nothing. The spread between the 10-year US versus Germany has really started to close up, approaching 200 basis points. Do you think that can go even narrower? And what kind of levels do you think this can go to?
Well, I do think it can go a little bit narrower, and probably not a whole lot, but you could see it move a little bit more. Just because if you have the weight of the Bund yield sitting there, that can pull on the U.S. yield and vice versa. But I don't think things are turning around in Europe. I think things are just not getting worse in Europe.
On that spread, Colin, your thoughts?
My thoughts are that it could still widen out a little bit, but ultimately, if the Bund starts to move down further negative in yield, I do believe it'll drag the U.S. with it, and I think that's part of what's not happening right now. Whereas if I say I like 10 years at 180, there's got to be a reason. One of the reasons is I don't think that drag is really in the market.